Kotak Mutual Fund presents Faidelal Ke Funde.
Hello, this is your wealth coach Faidelal. Today I will explain debt funds to you and also tell you about different types of debt mutual funds and their various benefits. Debt mutual funds generate returns by investing a majority of their corpus in debt instruments such as government bonds, corporate bonds, and deposits of various kinds. In general terms, bonds are simply a promise to repay money with interest in the future. While equities represent ownership, shares in a corporation, a bond is an IOU that obligates the issuer of the bond to pay the investor a specified amount of money at regular intervals and to repay the principal value, the face value of the bond at a given future date. Debt funds are considered less risky than equities because their values tend to be relatively more predictable. But as with any investment, there is always some risk involved that you should understand before you invest. There are different types of debt mutual fund schemes available in the market. Here, I will tell you about 4. Liquid funds are funds which invest in highly liquid money market instruments and provide easy liquidity. In fact, you can invest in these funds for as short as a day. This type of fund is an excellent tool to park your surplus cash for a short period. Gilt funds invest in government securities of medium and long-term maturities issued by central and state government and with no default risk. But it does come with some amount of interest rate risks and therefore quite volatile in the short term. Income funds invest a major portion of various debt instruments such as bonds, corporate debentures, government securities, and money market instruments. This type of mutual fund scheme works well for long-term investors who have a higher risk-taking appetite. These schemes have interest rate risk associated with it. These funds are best when one has long-term horizon of 1 year or more. And finally, monthly income plans. These are not purely debt mutual fund schemes as they are more like hybrid funds. This is because these schemes allow you to get diversification benefit by investing in both debt and equity. Of course, majority of the corpus is invested in debt instruments, almost 70 to 95%, and the remaining 5 to 30% in equities. Do keep in mind that due to the equity portion, you have the potential to earn a higher return than a pure debt fund. Today, I have mentioned only 4 debt MF schemes. There are many more such schemes such as dynamic bond funds, fixed maturity plans, capital protection oriented funds, and the like. So come back next time around and I'll tell you more.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.